a legacy company known for plastic action figures and board games, just posted software-level profit margins of 51% in their gaming division.
Yeah, right, which is just wild.
Right. Let that sink in for a second. We are looking at a century-old toy manufacturer that is suddenly sporting unit economics that you would, normally associate with some Silicon Valley sauce darling.
Oh, absolutely. It's a total paradigm shift.
It really is. Today we're looking at how Hasbro's Q1 2026 earnings just completely flipped the script on what a toy company actually is and what it means for anyone holding the stock.
Because it means a lot, frankly.
Exactly. Welcome to Talk Tickers. We're getting data forward, stripping out all the corporate doublespeak, and focusing on the actionable insights from Hasbro's latest earnings call.
The transformation happening inside this company is, well, it's just wild to watch in real time.
It really is.
Because when you parse the transcript, the management commentary, the Q&A session with the analyst, you aren't just reading an earnings report.
Right.
You are reading a strategic pivot. A pivot from physical plastic to digital and tabletop IP dominance.
And the analysts were absolutely buzzing about this. I mean, Hasbro started 2026 by just blowing the doors off expectations.
They really did.
Let's look at the top line. Q1 net revenue hit $1 billion. That is a 13% increase year over year.
Which is huge.
It's massive. I mean, in a post-holiday quarter, right? In a macro environment where consumer discretionary spending is supposedly tightening up, finding double-digit top-line growth is a massive signal for you as an investor.
It's a massive signal because the first quarter is traditionally a retail desert.
Oh, totally.
You've just exited the holiday shopping frenzy.
Yeah.
Consumers are tapped out, right? Credit card bills are coming due in January and February.
It's a post-Christmas hangover.
Exactly. And retailers are busy clearing out excess inventory. They are not loading up on new product.
Right. They're trying to empty the shelves, not stock them.
Yeah. So to see $1 billion flow through the top line, marking 13% growth against those specific seasonal headwinds, it tells you that their product portfolio has decoupled from the traditional holiday toy cycle.
Okay, let's unpack this, because revenue is one thing, but as retail investors, we care about what actually falls to the bottom line.
Always.
Adjusted operating profit was $287 million. That is a staggering 29% increase from the previous year.
Yeah, that's the number that really jumps out.
Right. We are seeing profit grow at more than double the rate of revenue.
Which is the dream scenario.
Exactly. That delta between 13% top-line growth and 29% bottom-line growth is, honestly, it's the entire story of this quarter.
That delta is the pure expression of operating leverage.
Right.
When your gross margins widen and your fixed costs hold steady, every incremental dollar of revenue carries disproportionately more profit.
Because the overhead is already paid for?
Exactly. This is what legacy companies strive for, but they rarely achieve it at this scale without massive, painful restructuring.
Let's put some specific numbers on that leverage, because the margin expansion here is what really caught my eye.
Oh, the margin extension is beautiful.
It is. Adjusted operating margin expanded by 360 basis points to reach 28.7%.
That is a massive jump.
And adjusted EPS, so earnings per share, came in at $1.47. That is a 41% year-over-year jump.
41%.
Let me repeat that for you guys listening.
Right.
A 41% jump in earnings per share for a company founded in 1923.
It's almost unheard of for a company that old.
Right. And just rounding it out, adjusted EBITDA hit $339 million, which is up 24%.
What's fascinating here is that a 360 basis point expansion in a single year is monumental for a company dealing in physical goods.
Because they actually have to make stuff.
Right. We're talking about an enterprise that has to design, manufacture, package, ship, and distribute millions of physical items globally.
Real-world logistics.
Exactly. Finding an extra 3.6% of margin across $1 billion of revenue implies a ruthless optimization of their cost structure.
Which they actually talked about on the call.
They did. Management confirmed this, noting they've already realized $37 million in gross savings in Q1 alone.
And that $37 million is pacing them perfectly toward their stated goal of $150 million in annual savings.
Right.
On track.
But I want to pause on the idea of operating leverage for a second.
Sure.
Because we aren't talking about a food truck where you cover the cost of the truck and the rest is profit. We are talking about an IP engine.
It's much closer to video game development, honestly.
Yes. Building the initial architecture, writing the lore, designing the game mechanics, that costs a fortune up front.
Right, the R&D phase.
But whether one person buys a booster pack or 10 million people buy booster packs, that development cost is already sunk.
Yep.
So every pack sold after break-even is almost entirely profit.
And that bridges perfectly to how they actually achieve these numbers. Because that 28.7% overall margin isn't coming from the traditional toy aisles at big box retailers.
No way. Target and Walmart aren't giving them those margins. You cannot squeeze those kinds of margins out of injection molded plastic and cardboard boxes shipped across the Pacific.
It's just too expensive.
Right. The retail partners demand too much of the cut, the shipping costs are too high, and the raw materials are, way too volatile.
Which means the traditional toy business is masking something incredibly lucrative underneath.
Exactly.
To understand a 41% EPS jump, you have to look away from the action figures and look directly at the gaming table.
The tabletop.
Specifically, Wizards of the Coast and their digital gaming segment.
This is the core growth engine of the company.
Period.
Wizards of the Coast, or WOTC, along with digital gaming, generated $582 million in revenue this quarter.
Wait, $582 million?
Yeah, that is a 26% surge year over year.
Over $500 million in a single quarter.
Just from that segment.
So out of the company's entire $1 billion revenue pie, OTC is taking up well over half.
Exactly. But here is the real jaw dropper.
Okay, hit me.
We mentioned the company's overall operating margin was 28.7%, right?
Yeah.
Wizards of the Coast's operating margin was an unbelievable 51.2%.
That is insane for a physical product.
That figure fundamentally changes how you have to value this stock.
Because it's not a toy company metric.
Right. A 51.2% operating margin means that for every dollar a consumer spends on this segment, Hasbro is keeping more than 51 cents as operating profit.
That completely breaks the mold of a consumer packaged goods company.
Those are premium software margins.
It's Apple-level, Microsoft-level efficiency just hiding inside a toy company.
Hiding in plain sight.
And it is being driven by an absolute cultural behemoth, Magic the Gathering.
Oh, yeah. Magic is the golden goose.
The transcript highlights that a new set called Laura Wynn Eclipsed launched in January. It didn't just do well, by the way. It became the best-selling premiere set of all time.
Setting a record like that in January is impressive enough, right?
Yeah.
But the velocity of the release schedule is what really stands out to me.
They just keep pumping them out.
Yeah, the management team noted that just months later, the subsequent release, Secrets of Strixhaven, immediately surpassed Laura Wynn Eclipsed.
Wait, really? It beat the record that was just set?
Yes. They are breaking their own all-time sales records back-to-back within a single quarter.
And it isn't just the hardcore legacy fans buying these sets anymore.
No, the audience is broadening.
The organized play statistics, like people actually showing up to stores to play in tournaments, hit the highest engagement level seen since before the pandemic.
Which is a great indicator of ecosystem health.
But what I find even more strategic is how they're widening the funnel for new players.
Oh, the collaborations.
Yeah, they rolled out a Teenage Mutant Ninja Turtles collaboration under their Universes Beyond banner, and it completely outpaced internal expectations.
The Universes Beyond strategy is arguably the most important customer acquisition tool they have developed in a decade.
I would completely agree with that.
Traditionally, Magic the Gathering relies on its own proprietary high fantasy lore, right?
Wizards, elves, dragons,
Yeah.
that whole vibe.
Exactly. That appeals to a very specific demographic.
Yeah.
But the mechanics of the game, the rules, the math, the strategic depth, they are universally brilliant.
It's arguably the best card game ever designed.
So what Universes Beyond does is decouple the game mechanics from the proprietary lore.
Right, so they can go to a massive fandom that has never played a trading card game in their life and say, hey, maybe you don't care about our fantasy world, but you love Leonardo and Donatello.
Exactly.
We took the rules of our game and layered your favorite characters right on top of it.
It's an immediate on-ramp for a completely fresh demographic.
It drastically lowers the barrier to entry.
It really does. I mean, someone might be intimidated by 30 years of Magic lore, but they know exactly who Shredder and Splinter are.
Yeah, the nostalgia factor is huge.
Once they buy the TMNT set, they learn the rules of the game. And once they know the rules, they are highly likely to start exploring the broader Magic ecosystem.
It acts as a highly profitable Trojan horse for user acquisition.
Trojan horse is the perfect way to describe it.
And we are seeing the proof of that in the backlist sales.
Oh, the backlist numbers are wild.
If Universes Beyond is bringing in new players, those new players want to catch up, right? They want older cards. The management call mentioned that demand for their older avatar, The Last Airbender and Final Fantasy sets is pushing 2026 to be the third largest backlist year in the game's entire history.
And we are only through the first quarter.
Right. We have 3 more quarters to go.
The concept of a backlist in physical gaming is incredibly lucrative.
Because the hard work is done.
Exactly. You've already paid the artists, you've already balanced the game mechanics, and the marketing is, well, it's largely community-driven at that point.
The players market it to each other.
Printing more of an old set requires minimal R&D expenditure. When backlist sales surge, it acts as a direct multiplier on your operating margin.
Plus, the community aspect is spilling over into physical events at an unprecedented scale.
The conventions.
Yeah, MagicCon Las Vegas sold 23,000 badges.
That's a massive event.
It makes it the largest Magic event in history. And they noted MagicCon Amsterdam is on track to sell out as well.
The global demand is definitely there.
People are flying across the world, booking hotels, and paying premium badge prices just to play cardboard with strangers.
Which proves the stickiness of the IP.
Totally.
But if we shift from the physical cards to the purely digital realm, the margins get even more extreme.
If you can even imagine that.
Digital licensing is becoming a massive pillar for them.
Here's where it gets really interesting. Monopoly Go.
The mobile game.
Yes. This mobile game generated $41 million in digital licensing revenue for Hasbro in just this quarter alone.
$41 million for doing basically nothing.
Management described it as a juggernaut. They explicitly said it's the financial equivalent of having a couple of blockbuster movies worth of incremental licensing and product sales every single year, but without any of the box office risk.
The risk asymmetry here is a beautiful thing for retail investors to understand.
Explain that a bit more.
Yeah, Hasbro did not build Monopoly Go. They didn't spend tens of millions of dollars paying software engineers. They didn't rent the server space. They didn't pay for user acquisition ads on social media.
A third-party developer named Scopely took all of that financial and operational risk.
All of it. All Hasbro did was hand over the rights to use the Monopoly IP.
The top hat, the boardwalk, the jail.
Exactly. And in exchange, they take a percentage of the gross revenue.
Pure royalty stream.
Right. That $41 million requires virtually zero capital expenditure from Hasbro.
It flows almost entirely unencumbered straight to the bottom line.
Yes. When you combine the 51% margins of the physical card business with the nearly 100% margin of digital licensing, I mean, the financial architecture of this segment is bulletproof.
But then you have to reconcile that with the rest of the company.
Yeah, the legacy stuff.
Because WODC and digital gaming are printing money, but consumer products, the traditional toys, the Transformers, the Play-Doh, that segment was totally flat year over year at $398 million.
And it actually posted an adjusted operating loss of $41 million.
A loss, which is a huge drag on the overall business.
This highlights the danger of relying purely on consolidated top-line metrics when you're looking at a stock.
If you just look at the $1 billion in total revenue, you miss the internal dynamics entirely.
You essentially have 2 completely different businesses sharing a corporate treasury.
Right.
One is an IP-driven, high-margin growth engine, and the other is a legacy, capital-intensive manufacturing operation.
Let me push back on that 2 businesses idea for a second, though.
Okay, go ahead.
I don't think they are just operating side by side. I think one is actively subsidizing the other.
Oh, I see what you mean.
Wizards of the Coast is the high-margin printing press that's funding the operationally expensive physical toy side.
Yeah, that's a fair assessment.
Without WODC's $582 million, the traditional toy business wouldn't be able to float its own infrastructure.
Probably not, no.
Management even mentioned a huge shift in the industry on the call. They said trading cards are on track to eclipse building sets like Lego as the hottest category in toys and games.
That is a seismic shift in consumer behavior.
It really is. I mean, Lego has been the king forever.
Right. Building sets have dominated the global toy market for decades because they appeal to both children and adult collectors.
The cross-generational appeal.
Exactly. So for trading cards to actually overtake them indicates a fundamental change in what consumers value.
They are valuing mechanics, collectability, and, social play over static physical construction.
And Hasbro's management seems completely aware of this shift.
They do. They outlined a strategic framework on the call that they call the GEM squared categories.
Right, GEM squared.
Gamified, entertainment-driven, multi-purchase, and multi-generational.
It's a great acronym.
I love this concept because it perfectly articulates why a Magic card is a fundamentally better business model than an action figure.
It's a brilliant mental model for capital allocation.
Let's break it down for the listener.
Let's do it. So gamified means it has rules and active engagement, right? It's not just a passive object sitting on a shelf.
You actually interact with it over and over.
Exactly. Entertainment-driven means it taps into deep lore, storytelling, or external media like movies and shows.
Multi-purchase is the holy grail for a business.
Oh, absolutely.
You don't just buy a Magic deck once and you're done. To stay competitive, you continuously buy booster packs, expansions, and new sets.
It acts like a physical subscription model.
Exactly. And multi-generational means it has been around long enough, 30 years in Magic's case, that parents who played in the 90s are now buying cards to teach their kids.
Compare that framework to a standard plastic action figure.
Yeah, it's night and day.
A child begs for it, buys it once, plays with it for a few weeks, and then it goes into a toy box forever.
Gathering dust.
It is a single purchase, single generation, non-gamified transaction with absolutely zero recurring revenue potential.
And the proof is in the data. Management stated that these gem-squared categories grew by 22%, while the broader, traditional toy industry actually shrank by 3%.
So they are consciously pivoting the entire weight of the company toward categories that have structural, built-in advantages.
They're following the money.
But, pivoting toward highly volatile, massive demand products creates a completely different set of operational headaches.
Oh, for sure. The supply chain issues.
Right. When a trading card category gets this hot, your primary bottleneck stops being marketing and starts being supply constraints.
You just can't print them fast enough.
Exactly. If Secrets of Strixhaven sells out immediately, every single day the shelf sits empty is lots revenue.
Right, and printing millions of highly specific, randomized pieces of cardboard with premium foil treatments to meet surging global demand isn't as simple as turning on a Xerox machine.
Not at all. It's a highly complex manufacturing process.
Management noted that in the past, they could turn around a reprint in about 6 weeks. But now, because the entire industry's demand is so high, it takes 3 to 4 months to get a reprint out the door.
And that kind of lag time can completely kill momentum.
It's a momentum killer for sure.
If players can't get the cards they need to build competitive decks, they lose interest. Secondary market prices skyrocket out of control, and consumer sentiment turns toxic.
Which you never want.
So Hasbro has to tackle this supply chain bottleneck aggressively, and they are doing it through 2 distinct avenues.
The first is physical redundancy, right?
Yes.
They aren't relying on a single massive printing facility anymore. They told analysts they have validated multiple paper and cardstock sources across the US, Germany, and Japan.
Global diversification of highly specialized manufacturing.
Right, because cardboard for trading cards isn't just standard paper.
No, it has a specific core, specific weight, and requires proprietary cutting and sorting machinery to ensure the randomization is perfect.
You can't just go to a local print shop.
Exactly. By spinning up facilities in Germany and Japan alongside the US, they're protecting themselves against regional disruptions.
Whether that's a labor strike, a shipping bottleneck, or localized raw material shortages.
Yeah. If the US facility is backed up, they seamlessly route the digital files to Europe.
It's expensive to set up, I'm sure, but it guarantees throughput.
It's an insurance policy.
But to me, the second strategy they are using to manage supply is the real stroke of genius because it's entirely behavioral.
Oh, this is fascinating.
They actually changed the rules of the game to manipulate the supply chain.
You're talking about the rotation shift.
Exactly. For years, the standard competitive format of Magic the Gathering required players to use cards printed within a specific time frame, usually like the last 18 to 24 months.
Right.
After that, those cards rotated out and were no longer legal in standard tournament play.
Which forces a constant cycle of purchasing.
Right.
It sounds great for short-term revenue,
Right.
but it creates a massive panicked rush on the printers every few months.
Because everyone needs the new cards all at once.
Yes. Players are forced to buy the newest sets immediately, creating massive demand spikes that the printers simply cannot handle under current conditions.
So what did Hasbro do? They extended that rotation timeline to 32 to 36 months.
A huge extension.
Cards now stay legal to play for a full year longer.
And the secondary effects of that decision are profound.
Tell me about it.
For the player, it massively boosts consumer confidence. If you drop $100 on a rare card, You feel much better about that investment, knowing you can use it competitively for 3 years instead of a year and a half.
It lowers the perceived cost of entry and retention.
Exactly.
But the real magic, pun intended, is what it does for Hasbro's logistics.
Oh, it's brilliant.
By making the cards relevant for longer, it flattens the demand curve. Players don't have to rush out and buy everything on day one.
They can space out their purchases over a longer horizon.
It stretches out the purchasing window, taking the acute pressure off those short-term printing crunches.
It is a masterful example of using game design to solve a manufacturing problem.
It really is.
They didn't just throw money at more printers.
Yeah.
They altered the behavioral economics of their player base to smooth out their supply chain.
That is exactly the kind of granular insight you only get when you read the transcripts and look past the top-line numbers.
Which is why we do this.
Exactly. So we've established the foundation here. Wizards of the Coast is a 51% margin juggernaut. Q1 crushed expectations across the board.
Crushed them.
Revenue is up 13%, operating profit is up 29%, EPS is up 41%.
By any traditional metric, it is a stellar report card. The business is firing on all cylinders.
Which brings up a massive flashing red question mark.
Here we go.
If WOTC is printing money, and Q1 was this huge, indisputable beat, why on earth did management flat out refuse to raise their guidance for the rest of the year?
Yeah, they maintain their old forecast.
That is the pivotal question for anyone analyzing this stock.
It really is. When a company beats Q1 estimates by a wide margin, but refuses to adjust their full-year outlook upward, the market inherently gets suspicious.
You assume they're hiding something bad.
The immediate assumption is that management sees a cliff approaching in the next few quarters that will wipe out all those Q1 gains.
Let's look at the guidance. They reiterated their full year 2026 guidance. 3 to 5% consolidated revenue growth, 24 to 25% adjusted operating margins, and $1.4 to $1.45 billion in adjusted EBITDA.
Right.
Now, keeping in mind, they just posted nearly 29% margins and 13% revenue growth. Forecasting 3% growth and 24% margins for the year implies a serious slowdown is coming.
And in the earnings call, they were incredibly transparent about the friction causing that conservative forecast.
They laid it all out.
They did. It's a combination of one-time shocks, macroeconomic realities, and intentional internal investments.
Let's start with the one-time shock, because this is wild. At the end of March, right as the quarter was closing, Hasbro suffered a significant cyber attack.
A malicious intrusion.
Yeah, that forced them to essentially pull the plug on large portions of their IT infrastructure to contain the threat, protect their data environment, and lock out the bad actors.
Which is standard protocol, but disruptive.
Very. Management was very clear about the immediate financial toll. It will cost $20 million in one-time operating expenses just for the remediation.
Just cleaning it up?
That's hiring the forensic cybersecurity consultants, cleaning the servers, upgrading the firewalls, and, managing the legal fallout.
But what I found fascinating is where the attack actually disrupted the business.
Right, because it didn't stop them from making toys.
No, because their manufacturing is largely outsourced to third-party co-manufacturers in Asia. Those factories kept churning out product.
The disruption hit their internal plumbing.
Specifically, their order management, shipping logistics, and invoicing systems.
And this is a crucial distinction for retail investors to internalize.
Oh, absolutely.
Making a toy doesn't put money on the income statement. Putting a toy in a warehouse doesn't put money on the income statement.
Nope.
You only recognize revenue when you ship that toy to a retailer like Target or Amazon and send them an invoice.
And because of the cyber attack, Hasbro's invoicing systems went dark.
They literally could not send the bills to their biggest clients.
The mechanical failure to invoice resulted in $40 to $60 million in consumer products revenue that was supposed to be recognized in Q2 being delayed and pushed into the second half of the year.
Just push down the calendar.
Furthermore, the actual cash collections, the liquidity hitting their bank accounts, is shifting from Q2 into Q3.
So as an investor, if you are looking at their Q2 earnings report a few months from now and the cash flow looks terrifyingly low, you don't panic.
Do not panic.
You know it's an accounting artifact from a March cyber attack, not a collapse in consumer demand for their products.
Exactly. It is a mechanical timing delay, not a structural flaw in the business model.
That's a great way to put it.
In fact, management explicitly noted that their point of sale data The real-time metrics of what consumers are actually scanning at the registers at Walmart and Target remains incredibly strong.
The demand is there. The paperwork just got held up. Okay, so they have to eat a $20 million cleanup bill and shift $60 million of revenue into the back half. That's the cyber headwind.
But then there are the macro headwinds.
And this is where global economics collides directly with consumer goods. Oil prices.
Oil is everything for physical goods.
Management highlighted that oil hovering around $100 a barrel is going to create a $30 million headwind in Q3 and Q4.
To understand why a toy company cares so deeply about the price of crude oil, you have to trace the petroleum life cycle of their core consumer products.
It impacts their margins across three distinct vectors.
The resin, the freight, and the packaging.
Let's break those down.
First, the resin. The plastic used to mold a Transformers action figure or a Marvel Legend is directly derived from petroleum.
So when oil goes up, the plastic goes up.
When crude oil spikes to $100 a barrel, the raw material cost of every single plastic item in their portfolio increases.
And second, freight.
They manufacture in Asia and sell globally. The bunker fuel for their massive container ships crossing the Pacific and the diesel for the long-haul trucks moving product from the ports to the distribution centers, all of that skyrockets.
And finally, the packaging, the blister packs, the plastic windows on the boxes, even the energy used to produce the cardboard, it's all tied to global energy markets.
So $100 oil translates directly into a $30 million hit to their traditional consumer products line.
Though it is worth noting the incredible balancing act of global supply chains. They mentioned this $30 million oil hit is being partially offset by a $15 million benefit from lower tariff expenses.
Changes in geopolitical trade policies are softening the blow of global commodity inflation.
It's a perfect example of why managing a legacy physical goods business is so agonizingly complex compared to digital gaming.
Oh, completely.
But speaking of gaming, the final reason they are keeping guidance flat is the pacing of Wizards of the Coast itself.
They expect growth to moderate in the second half of the year.
And this comes down to two factors. First, they are facing incredibly tough comparables. Q4 of last year was a blowout quarter for WOTC.
Beating those numbers year over year requires a monumental effort.
Right. But second, and more importantly, they are intentionally suppressing their near-term margins by stepping up internal investments for the future.
They're heavily funding the development of two major digital game titles slated for 2027, Exodus and Warlock.
Video game development is notoriously capital intensive.
Huge upfront costs.
You are paying teams of hundreds of highly skilled developers, artists, and engineers for years before you see a single dollar of revenue.
Hasbro is making the conscious decision to spend that money now, taking the margin hit in the second half of 2026 to build the IP infrastructure that will drive revenue in 2027 and beyond.
So let's connect all of these dots. Here's where it gets really interesting.
Okay.
We have a cyber attack that costs $20 million to clean up and freezes $60 million in invoicing.
Yep.
We have oil at $100 a barrel, driving a $30 million cost increase across plastic and shipping.
Right.
And we have massive internal capital expenditures for future video games.
Wait, so they aren't raising guidance because they are choosing to eat all of these costs out of their massive Q1 surplus?
This raises an important question. If we connect this to the bigger picture, what Hasbro's management is demonstrating here is extreme operational agility and prudent risk management.
That's not weakness. That is just a massive flex of their balance sheet.
Oh, it's huge flex.
Many companies, if hit with a cyber attack and surging oil prices, would immediately issue a profit warning.
They would use the macro environment as an excuse to lower their guidance and brace the market for an earnings miss.
But Hasbro didn't do that.
They absorbed the shock.
Yeah.
They looked at the $50 million plus in unexpected friction from cyber remediation and oil inflation, and they basically said, we have enough momentum in our high-margin digital business, and we've executed enough cost savings in our supply chain that we can take this hit and still deliver the exact year we promised you. They have the ammo via their pricing power and their $150 million productivity plan to just offset the chaos.
Keeping the guidance flat in a highly volatile macro environment isn't a red flag. It's a testament to the resilience of their new operating model.
They're telling the market, we can take a punch and keep moving forward.
Which is exactly the kind of stability and predictability that institutional and retail investors crave.
So we've dissected the top line numbers. We've explored the insane 51% margins of the gaming division. We've broken down the supply chain mechanics of Magic cards, and we've weighed the cyber and macro headwinds.
We've covered a lot of ground.
So what does this all mean? Let's parse all this data into an actionable bottom line for you, the investor. Let's look at how they are managing their capital, because that tells us what they really believe about their own future.
A company's capital allocation priorities are the ultimate truth teller.
Actions speak louder than words.
Management can say whatever they want on a call, but how they spend their cash reveals their actual confidence level.
And the cash flow looks robust. They generated $338 million in operating cash flow in Q1. Out of that, they returned $99 million directly to shareholders via dividends.
Maintaining a strong, consistent dividend while navigating a major corporate transition and a cyber attack is a powerful signal of cash flow reliability.
It provides a floor for the stock and rewards patient investors.
But the financial maneuver that really stood out to me was their debt restructuring.
Oh yeah, talk about that.
They issued $400 million in new corporate debt. But they didn't do it to fund operations.
No.
They did it with the explicit purpose of fully repaying their debt maturities that were coming due in November 2026 and applying the remaining balance to repurchase their higher rate, longer dated debt.
This is a highly sophisticated, shareholder-friendly move.
It is essentially corporate mortgage refinancing.
Exactly. They went to the debt markets, secured $400 million at favorable terms, and used that fresh capital to immediately retire old debt that carried oppressively high interest rates.
By doing that, they are cleaning up the balance sheet, pushing their maturity dates further into the future to eliminate near-term default risk, and structurally lowering their ongoing interest expenses.
That frees up more free cash flow every single quarter going forward.
And they are using that freed up cash flow aggressively.
Alongside the debt cleanup and the dividend, they also initiated share repurchases under a recently authorized program.
Buying back your own stock reduces the overall share count, which artificially boosts the earnings per share for the remaining investors.
So they are paying dividends, buying back stock, restructuring debt to lower interest payments, all while internally funding the massive expansion of Wizards of the Coast.
And that expansion pipeline is packed with upcoming catalysts.
We touched on the Universes Beyond strategy earlier, but the cross-IP collaborations they are setting up are staggering in their scale.
Oh, really are.
They highlighted an upcoming Magic the Gathering animated series on Netflix.
Management clearly believes this will be one of the biggest animation events of the year.
If you look at what Arcane did for League of Legends or what Edgerunners did for Cyberpunk, a hit Netflix show acts as a massive, globally scaled commercial for the core game.
It drives millions of eyeballs to the IP who would never have walked into a local hobby shop.
And once they watch the show, Hasbro has the digital infrastructure ready to catch them.
They're actively integrating Marvel and Spider-Man into Magic Arena, their online digital platform.
And they are establishing a one-to-one compatibility between the physical cards you buy and the digital cards you play with online.
You buy a physical pack, you get a code, you unlock those same cards in the app.
They are building a centralized, inescapable ecosystem for pop culture gaming.
They aren't just a toy company licensing out IP. They're creating the definitive platform where all other massive IPs want to exist.
If you look objectively at the facts presented in this call, the 51% operating margins in the core growth engine, the aggressive debt restructuring, the robust cash flow, and the pipeline of pop culture integrations, I take a definitively bullish stance for the retail investor.
I completely agree. Let's recap the thesis. You have a legacy consumer products business that is flat, yes.
It's dealing with $100 oil and cyber delays.
But it is stable enough to generate cash. And sitting on top of that flat foundation is Wizards of the Coast, operating as a structurally advantaged, highly durable growth engine.
They have proven they can acquire new players through the Universes Beyond collaborations.
They have proven they can retain those players through extended 36-month rotation cycles and booming live events like MagicCon.
And they have proven they can monetize digital IP at near 100% margins through deals like Monopoly Go.
The cyber attack and the oil prices. They are temporary speed bumps.
They are operational friction points that cost money today, but don't break the structural model of the company tomorrow.
When a company can take those hits, maintain guidance, pay down debt, and buy back stocks simultaneously, you have a very compelling investment case.
The market often misprices companies that are going through a profound identity transition.
Analysts tend to focus too heavily on the stagnant legacy business, the plastic action figures, and severely undervalue the high-margin digital growth engine exploding inside of it.
And that is the perfect note to end on. We've dug deep into the transcript, parsed the margins, and translated the strategy.
Hopefully we stripped out the jargon for you.
But before we sign off, I want to leave you with one final provocative thought to chew on as you look at your own portfolio this week.
Give it to them.
For 100 years, the stock market has put Hasbro in a very specific box. They have been valued and traded as a toy company.
Valued alongside companies that purely manufacture physical goods and fight for shelf space at big box retailers.
But look at the data we just covered. With Magic the Gathering pushing so heavily into social play like the Commander format, with their digital platforms expanding via Arena, with Monopoly Go pulling in zero-cost licensing revenue, and with massive pop culture crossovers bringing Marvel, Teenage Mutant Ninja Turtles, and Netflix into their ecosystem.
Math changes.
Is it time for the market to permanently reevaluate this stock? Is it time for you, as an investor, to stop valuing Hasbro as a traditional toy company and start valuing it as a premium, high-margin gaming and IP powerhouse?
It is entirely a question of valuation multiples. Software and IP companies trade at significantly higher multiples than consumer packaged goods companies.
If the market starts to view Hasbro through the lens of Wizards of the Coast, the entire valuation paradigm shifts.
The upside there is massive.
Think about that as you review your holdings. Keep asking the hard questions. Keep looking past the top-line revenue to see where the margins are actually being made, and we will catch you on the next deep dive.